Welcome back to the Deep Dive. Today, we are unpacking the full intelligence brief from the reserve of KING-KAMBUF Financial News and Reports magazine, Weekly Market Digest and Investment Analysis.
And this is the trading edition for the week ending on Friday, December 12th, 2025.
So our mission today is to go way beyond the headlines. We're going to get into the weeds of this report all the way down to the actionable strategies from the TKOF 20+ trading system.
Right. For you, the listener, this is about translating all that data into a clear plan for the coming week, which is December 15th through the 19th.
And it's a really important week to have a plan because the signals we got on Friday were, they were incredibly contradictory.
Contradictory is the perfect word. I mean, you look at the Dow and it's floating near all-time highs. That should signal euphoria, right? Stability.
Yeah, but then you look at the NASDAQ.
And it's a totally different story. A sharp retreat. Real concentrated selling pressure in some of the biggest names in the market.
So you have fear and euphoria happening at the exact same time. The market is basically divided against itself.
It's a very tense structure. And this report, it really digs into that. It shows how the value side of the market is holding up, while that big crowded AI trade is getting stress tested in a big way.
The danger isn't obvious then. It's sort of hidden in the details.
Exactly. And that's why we need to map out where the capital is flowing and, more importantly, where a discipline system like TKIF is defining the exact entries and, crucially, the non-negotiable stops.
Okay, let's unpack this. We have a fascinating tension in the market data right now. Safety versus speculation. Let's start with section 1, the macro picture, because you're right. The index performance on Friday really tells a tale of two different markets.
It sets the stage for everything else. And the context you have to understand, the absolute foundation for all of this, is that we're in the post-Fed interpretation phase.
Right. The Fed just cut rates on December 11th. That was the big news.
The decision is done. It happened. The market got what it wanted, in a sense. But now we're in this much more volatile, sort of nerve-wracking phase of interpretation.
And what are we interpreting exactly?
We're asking, okay, with this accommodative policy, are the massive valuations in AI and mega-cap tech still justified? Especially, if there are signs of a broader growth slowdown on the horizon.
That's the conflict. The Fed is helping, but is the economy actually strong enough to support these prices?
And you see that conflict perfectly when you look at the major index status report in the KING-KAMBUF digest. Let's start with the Dow Jones.
Okay.
It closed at 48,458.05. It was only down 0.5% on the day.
Which, in the grand scheme of things, is nothing.
It's barely a blip. And more importantly, the report highlights that the Dow is currently the strongest of the major indices. It's near record highs. It had a strong week, up about 2.0%.
So what does that signal to you?
It signals a deep institutional preference for stability. This is big money moving into traditional value, blue chip companies, names with stable dividends. The Dow is basically saying everything is fine.
But everything is clearly not fine if you look at the broader market, the S&P 500.
Totally different story. It closed at 6,812.63, and it pulled back a full 1% from its recent highs.
That's a much more significant move. That's not just noise.
No, that is a signal of aggressive profit-taking. Now, don't get me wrong, the S&P is still having a great year, up over 13.5% year-to-date. But that move on Friday, it was a clear, high-volume rejection right at that peak. It suggests institutions are saying, okay, this is high enough for now.
And the real pain, the source of all that anxiety, was where you'd expect it to be, the NASDAQ.
The NASDAQ composite, yeah. It got hit the hardest, down 1.13% to 23,327.73.
Because that's where all the big tech and AI names live.
It's the concentrated home for that trade. So when it gets weak, it's a direct reflection of those valuation jitters we were talking about. It's a fundamental concern about where future growth is going to come from.
What's really fascinating to me, though, and what kind of stops this from being a full-on panic, is what the report says about the small caps, the Russell 2000.
Yes, the IWM. This is a critical piece of the puzzle. The Russell actually closed at a new record high earlier in the month.
A new record. So the smaller companies were showing incredible strength just recently.
Exactly. Now, it did pull back on Friday, down about 1.5%, in line with the general weakness. But the fact that it hit a record so recently tells you something important.
Which is?
It tells you that the fear isn't systemic. It's not a liquidity crunch across the entire economy. It's a localized, highly concentrated valuation fear, specifically within mega-cap tech.
So the capital's leaving the most crowded trade.
But it's finding other places to go, which brings us to maybe the most paradoxical indicator in the entire report. The volatility check.
You're talking about the VIX.
The VIX, yeah.
Yeah.
The SIBO volatility index, It closed the day at 14.85.
Which was down, right?
Down almost 6% on a day when the NASDAQ was getting sold off. That should not happen.
It seems completely backward.
It is, and that level, 14.85, is not just low, it is dangerously low. It's sitting just a stone's throw away from its 52-week low of 14.1.
So for you, the listener, what does that actually mean? Why does a low VIX matter so much?
It matters because it's a measure of the market's psychological state, and right now, that state is extreme complacency.
Nobody is worried.
Nobody is buying protection. The report explicitly says investors are underpricing what we call tail risks, those low-probability, high-impact events. They're not buying put options because the Fed cut rates, and everyone thinks the central bank will bail them out if things go wrong.
So if we put all the pieces together, we have the Dow signaling that everything is stable and safe.
Right.
The NASDAQ is signaling a concentrated panic in the most important sector of the market.
Yep.
And the VIX is signaling that nobody thinks there's any risk worth hedging against.
And that, right there, is the perfect recipe for a surprise. What the report calls a volatility of volatility event.
Explain that.
Because so few people are hedged, if we get a surprise, a bad earnings report from a bellwether, a terrible economic data point, the market is structurally positioned for a very sharp, very painful, and very rapid reversal.
Because everyone will be rushing for the exit at the same time.
At the exact same time. The real risk here isn't the fear that we see in the NASDAQ. It's the dangerous absence of fear that we see in the VIX.
It's the calmest part of the sea, right before you hit the hidden reef.
That's a perfect analogy.
Okay, so let's move into how that tension is playing out in the real world. Section 2, sector rotation. The report makes it very clear that the dominant theme on Friday was a flight to value.
A definitive flight to value, capital moving out of the high flyers and into more tangible, stable assets. We can see it clearly in the S&P 500 sector data.
So where was the outperformance? Where did the money go?
Two places mainly. Financials led the charge, up a really robust 1.8% on the day.
And that makes sense with a Fed rate cut.
It's the market behaving rationally. Lower rates can help bank profitability, their net interest margins. It signals confidence. So you saw names like JPM and Goldman Sachs do very well.
And the other sector?
Industrials. They were also extremely strong, up 1.2%. This is the market betting on a real global industrial recovery. It helps those big capital expenditure companies, like Boeing and Caterpillar.
Okay, so the money flowed into banks and big industrial companies. Where did it flow out of?
Well, exactly where you'd expect. The two sectors that have defined this market for the last year, technology was the day's worst performer. It dropped 1.5%.
And communications right behind it.
Down 1.2%. So it confirms this sharp, very localized rotation away from those high-growth, high-valuation stories.
And the report points to a specific trigger for this pressure on the NASDAQ. It was the AI trade coming under fire.
It was. And the catalyst was the disappointing earnings guidance from Oracle.
Oracle is a huge player in enterprise software, in the cloud. They're seen as a pretty good barometer.
A key player. And when their outlook was shaky, it sent immediate shockwaves across all the AI-related stocks. If a foundational company like Oracle is warning about a slowdown in spending, it makes you question the entire growth thesis.
It's a classic chain reaction. If Oracle's customers are pulling back, then investors start to worry about the companies that sell the picks and shovels for the AI gold rush, the chip makers, the infrastructure providers.
Which leads you directly to the mega-cap stress. The selling was not random, it was targeted at the bellwethers. NVDA was the big one.
Down what, over 3%?
Down 3.25% on very heavy volume. And you have to remember, NVDA has been the emotional and financial center of this entire AI debate. Its stock price is a referendum on the whole theme.
And it's not just one stock. The report highlights the bigger issue here, which is concentration risk.
A huge issue. Technology now makes up a colossal 30% of the S&P 500 index.
30%, that's massive.
It's enormous. So when that much of the index is tied up in just a handful of hyperscalers, NVIDIA, Apple, Microsoft, any shift in sentiment isn't just a ripple in a stock, it's a tidal wave for the entire index.
The report phrases the debate really well. It asks, who can credibly become a $10 trillion company next?
Right. You have these giants in the $4 to $5 trillion zone. The market has been pricing in near-perfect exponential growth to get them to that next level. When that growth path is even slightly questioned, like it was with the Oracle news, the kind of correction we saw is almost a mathematical necessity.
But let's get more granular, because the T-KIF radar analysis in the report shows that the rotation was more nuanced than just sell tech.
Very nuanced. It wasn't a blanket sell-off.
We mentioned NVDA getting crushed, down 3.25%. A clear, heavy volume sell day. But what about Apple?
Apple was fascinating. It was quietly resilient. It actually closed up a little bit, plus 0.11%.
So why? Why did Apple hold up when NVDA and others were getting hammered?
The report's analysis here is key. It characterizes Apple as acting like a bond proxy tech name.
What does that mean, a bond proxy?
It means it's seen as incredibly stable. It generates truly insane amounts of cash flow, and its valuation, while still high, is seen as safer and more predictable than the pure-play AI infrastructure names.
So when there's a risk-off rotation within the tech sector.
Capital flows to the fortress balance sheets. It goes into an Apple or a Microsoft, which are seen as safer harbors.
And then you have the complete outlier, the one that makes no sense on the surface, Tesla.
TSLA, yeah.
Yeah.
A huge high beta standout. The NASDAQ is bleeding red, and Tesla squeezes higher, up 2.70%.
That move just seems totally counterintuitive. What's the takeaway from that?
It proves that speculative risk isn't dead. It just rotated. Traders were clearly taking profits from that crowded AI trade and moving that speculative capital into other high beta names that were showing relative strength.
So the desire for explosive growth is still there.
It's absolutely still there. But the KMBUF analysis suggests that investors are demanding new, less congested ways to express that speculation.
Here's where it gets really interesting. This isn't a market collapse. It's more like a high-stakes negotiation. The market is asking, who actually deserves this valuation?
That's the perfect way to put it. It's a stress test. The market is moving from a phase of generalized, complacent euphoria, where you could buy almost anything, to a phase of highly selective strength.
Where you have to prove it.
You have to prove it. You need confirmed momentum. And for you, the listener, if you're learning how to navigate professional markets, understanding this shift is probably the most important lesson you can take away from this.
Okay, let's dig deeper into that selectivity. Section 3. Market extremes and the cannabis surge. The best way to see where the market's head is at is to look at what's hitting 52-week highs and what's hitting 52-week lows.
Exactly. These stress points give you the clearest signal. And the new highs list speaks directly to that flight to tangibles and stability we've been talking about.
What kind of names are we seeing on that list?
We're seeing major precious metals ETFs breaking out. We're seeing specialized manufacturing stocks. And we're seeing key financial services names, like the report calls out Federal Bank hitting 263.60.
So tangible assets, gold, manufacturing, banks.
Real stuff. The capital is looking for inflation hedges and stable cyclical recovery plays. It perfectly confirms the rotation we just discussed.
Now, the flip side of that coin is the record lows. And this is where the picture gets really stark.
The report flags these as critical risk areas, and they are concentrated almost exclusively in the highest risk, zero profit, most speculative corners of the market.
We're talking about crypto-related names.
Crypto names are getting crushed. The report highlights Argo blockchain, ARBK, which is down a massive 77.75% from its peak.
Wow.
And another one, CCH Holdings, down over 81%. This is brutal. This is institutional-grade risk offloading.
So what's the message here?
The message is that investors are trimming anything that is highly speculative and far from profitability, no matter how good the story might be. Liquidity is being pulled from the fringe and reallocated back to the core. This is not a friendly market for companies that run on faith alone.
So bifurcation is crystal clear. Safety and cyclicals are in. Aggressive loss-making spec stocks are out.
It's a ruthless culling, which brings us to the volume activity, because this is where a completely different story emerges. A specific sector just jumps off the page with massive volume.
The cannabis surge.
The cannabis phenomenon, yeah. The report details volume leadership here that is so significant it becomes a critical, actionable insight for the coming week.
Give us the numbers. The volume here is just staggering.
It really is. CBDMD, ticker YCBD, traded over 202 million shares.
200 million shares. And it was up what?
Up 87.80% in one day.
Incredible. And it wasn't the only one.
Not at all. Canopy Growth, CGC, traded over 76 million shares and was up 34.5%. Tilray, TLRY, traded almost 50 million shares and jumped 30%.
This is not just random retail traders. That kind of volume, that's something else.
No, this is coordinated. This suggests massive institutional consolidation, portfolio rebalancing on a huge scale.
And the synthesis in the report points to two factors driving this.
Two main factors, yes. First, the sector has been absolutely beaten down for years, so it's coming from deeply oversold valuations. And second, there's a renewed buzz, a renewed expectation of a potential catalyst, maybe U.S. legalization news or some kind of regulatory shift.
So when the big professional desks decide to rotate into a sector that's been this depressed for this long,
They have to move a lot of capital very quickly, and that's what creates this powerful, confirmed momentum. That's exactly the kind of setup that a system like TKIF is designed to identify. We'll come back to this in Section 5.
before we get there, let's just quickly touch on the top gainers and losers overall, just to get a final sense of the market's mood.
Good idea. On the gainer side, the top performer was a company called InView Medical, ticker EAD. And the gain was, well, it's almost unbelievable, up 927.22%.
A 10-bagger in a single day.
In a single day. It shows you that the appetite for small-cap speculation is still wildly alive, but it's incredibly concentrated. It's not broad-based. It's focused on very specific stories, usually with a tiny float and major news.
And the losers just reinforce the defensive theme we've been talking about.
Exactly. It's the same bucket of stocks.
Yeah.
Crypto-adjacent names getting hammered, speculative biotechs like Applied Therapeutics and Tenaya Therapeutics suffering steep double-digit declines.
So the summary is clear. Strength is concentrated in stability, like financials and industrials, and now in this new explosive momentum trade in cannabis.
Right. And anything that's speculative, unprofitable, or needs constant capital is being ruthlessly avoided. It's a very selective environment.
Which means you need extreme discipline to navigate it.
Which is why the TKI framework is non-negotiable.
Okay, this is the perfect transition. We've talked about the what, now let's talk about the how. Section 4, the TKIF 20 plus trading system framework. This is the engine that powers all the actionable ideas in the report.
And it's so important to understand the methodology. It's designed to take emotion completely out of the execution process.
How does it do that?
It's built on quantifiable technical factors. The core of it is the 20-period moving average, but it's combined with proprietary trend filters and analysis of volatility and momentum.
So its goal isn't just to find winners.
No, not at all. Its goal is to find trades where the risk is mathematically definable and disproportionately small compared to the potential reward. That's the whole game.
And before we even look at a single stock pick, the guide absolutely hammers home the non-negotiable risk management rules.
This is the most valuable part of the entire document. For anyone listening who is serious about learning discipline, this is the foundation of capital preservation.
Let's start with the most important one, the 2% rule.
The 2% rule. You must never, ever risk more than 2% of your total account value on any single trade, period.
Why is that number so critical?
Because it's what protects you from the inevitable losing streaks. Even the best systems, the best traders in the world, has periods where they lose. This rule ensures that a string of 5 or 6 bad trades doesn't wipe you out. It keeps you in the game.
Let's make this real for the listener. Say you have a $100,000 trading account. The 2% rule means your maximum risk on any one position is exactly $2,000.
Exactly $2,000. And this is where the formula in the report becomes so powerful for determining your position size.
Right. The formula is position size, account size, X times 2%, and entry price, stop price.
Let's walk through an example. Say the TKI system flags a trade where the stop loss is very tight, only $2 below your entry price. Say you enter at $102 and your stop is at $100.
So your risk per share is $2.
Right. So you take your $2,000 maximum risk and divide it by that $2 risk per share. That allows you to buy exactly 1,000 shares.
Which is a big position.
A very large position. But your total risk exposure is still strictly capped at that $2,000.
Now let's take a different example. A much more volatile stock, where the system says you need a wider stop, maybe $20 away from your entry.
In that case, you do the same math. $2,000 risk divided by the $20 risk per share. Now you can only purchase 100 shares.
So the system automatically forces you to reduce your size when the risk is higher.
That's the beauty of it. It takes the emotional decision, oh, I really like this stock, I want to buy a lot, completely out of the equation. It's mathematical, not impulsive.
And none of that works if you violate the second rule. Hard stops.
Hard stops. They have to be used religiously. You place the stop order the moment you enter the trade, and you never, ever move it further away to give a losing trade more room.
That's the cardinal sin of trading, right? Moving your stop because you hope it will bounce back.
It's the one that blows up more accounts than anything else. Mental stops fail. Hope is not a strategy. The TKI system is ruthless about this. The moment the price hits that stop level, you are out. No questions, no exceptions.
The third pillar is the risk-reward requirement. The system won't even consider a trade unless The potential reward is at least 1.5 times the risk.
A minimum RR of 1 to 1.5. This is your mathematical edge over the long run. If you stick to this, you can be wrong half the time and still be profitable because your average winning trade is significantly larger than your average losing trade.
And many of the setups we're about to discuss are even better than that, closer to 1 to 2.
Which gives you an even greater buffer.
Okay, so you've entered the trade with the correct position size, you set your hard stop. How does the system handle taking profits?
With the same level of discipline, using what's called the scale-out strategy.
You take profits in thirds.
In thirds, yes.
Yeah.
Because greed is just as dangerous as fear. The market rarely goes straight up to your final target. So the strategy is you exit 1/3 of your position at target 1.
That locks in some profit, pays for the trade.
Exactly. It reduces your stress and takes risk off the table. Then you exit another third at target 2. At this point, you've locked in significant gains, and your remaining position is essentially a risk-free trade.
What do you do with that final third?
You let it run. You trail the stop on that final piece. The guide is very specific. You set a trailing stop 0.5% below the highest price the stock hits after you've reached target 2.
So this is how you catch those massive unexpected moves higher.
That's how you turn a good trade into a great one without ever giving back all your profits if the stock suddenly reverses. You've already banked the core of the game.
This entire framework, from the 2% rule to the scale-out plan, it seems like it's as much a psychological defense system as it is a technical one.
That's exactly what it is. It's a set of rules designed to protect you from your own worst emotional impulses in the heat of the moment. And the success of the 5 trade setups we're about to go through depends entirely on the listener's strict adherence to this framework.
All right, let's get to it. After all that analysis of a very complex, very divided market, this is what everyone's been waiting for. Section 5, the 5 high-probability trade setups from the KING-KAMBUF system.
And again, we have to approach these as complete trading plans, not just stock tips. We're looking for that confluence of factors: powerful sector rotation, clear technical patterns, and strong volume confirmation.
Let's start with the one the report gives the highest conviction rating, which ties directly back to that massive volume we saw, Tilray, TLRY.
TLRY is the highest probability setup at 75% with an excellent risk-reward ratio of 1 to 2.5.
Okay, hold on. I have to push back on this a little bit because it seems contradictory. We just spent time talking about how the market is ruthlessly culling speculative loss-making companies. Tilray is a historically volatile Canada stock. How can the system assign a 75% probability to that? What makes it different?
That is the essential question to ask, and the answer is that the rationale here is not based on fundamentals. It's based on pure market mechanics. The overwhelming force of the sector rotation and the technical picture are what matter.
So it's the chart and the volume.
It's the chart and the volume. The system identified a powerful momentum breakout above a major long-term technical resistance level. The entry price, at $10.75, is precisely where TLRY closed above a resistance line that has held it down for months.
And the volume confirmed that breakout.
Confirmed it in a huge way. Friday's volume was over 400% of its 20-day average. That is sustained institutional buying pressure clearing a major technical ceiling. That's what gives it the 75% probability. The risk is then defined very tightly.
The stop is at $9.50.
A stop at $9.50. That's a $1.25 risk per share, which is very manageable. And the reward potential is significant, which is why the RR is so good.
Target Lufio is $12.50.
Right, where you take off the first third. And target 2 is $14. This is a textbook momentum trade. You're leveraging the sector's volatility, but you are strictly mathematically managing the downside.
Okay, moving from high momentum speculation to the flight to value thesis. We have 2 big financial names, starting with Goldman Sachs, GS.
GS is rated at a strong 70% probability with a good RR of 1 to 1.8. The rationale here is a continuation of that theme. The direct benefit from the Fed's rate cut and clear evidence of institutional accumulation in the stock.
So this is a trend-following trade.
A continuation pattern, exactly. The entry is defined at $198, with a stop at $185.
So the $13 risk per share.
Correct. And the targets are designed to capture that expected enthusiasm for financials heading into the end of the year. Target 1 at $215 and target 2 at $235. This is a structural value play.
And staying with that theme, we have the other big bank, JP Morgan Chase, JPM.
JPM is also rated at 70% probability, but with an even slightly better 1 to 1.9 RR. This reflects the confidence in JPM's leadership role in the sector.
And what's the technical picture like here?
It's beautiful. You have strong moving average alignment. The price is holding firmly above the 20-day moving average, which is itself trending above the 50-day. That's a sign of a very healthy, sustainable uptrend.
And the numbers?
The entry is at $207 with the stop at $195. That's a 12-point risk. The system is projecting a substantial continuation here, with target 1 at $235 and target 2 at $255. Both JPM and Goldman are core trades based on the Dow's underlying strength.
All right, let's circle back to the cannabis theme. The second high conviction trade in that sector is Canopy Growth, CGC.
CGC has a slightly lower probability rating at 65%, but it has a stellar 1 to 2.0 RR.
And the rationale is similar to Tilray, a rotation into a beaten-down name.
Purely technical and thematic, yes. It's a rotation into deeply depressed valuations, and it's confirmed by that exceptional volume of over 76 million shares. And because the stock price itself is so low, the potential percentage gains are just explosive.
Let's walk through the math on this one because the numbers are small.
The entry is set at $1.50 with a stop at $1.35.
So you're only risking 15 cents per share.
Only 15 cents. So if a listener applies their 2% risk budget correctly, they can take a very substantial share position because the dollar risk per share is tiny. But the targets are exponential in percentage terms.
Target 1 is $1.85.
That's a 27% gain right there. And target 2 is $2.15, which is a staggering 48% gain from the entry.
But the risk here is that a low-price stock can move down just as fast.
Just as violently, which is why adherence to that $1.35 hard stop is absolutely non-negotiable on a trade like this.
Okay, and the fifth and final setup rounds out the themes perfectly. It's the industrial recovery play Boeing, BA.
BA is rated at 65% probability with a good 1 to 2.0 RR. And this trade ties directly back to that industrial recovery theme and the strength we saw in the sector data.
And what's the technical setup?
It's a clean breakout setup. The stock is moving above a major consolidation zone, and it's being confirmed by the strength across the entire industrial sector.
So what are the defined risk parameters for Boeing?
The entry is at $182 with a stop at $170. That defines a $12 risk per share. The targets are looking to capitalize on that industrial optimism, with target 1 at $205 and target 2 at $225.
So these 5 trades really cover the key themes of the report: value continuation in financials and industrials, and explosive new momentum in cannabis.
They're 5 complete plans. Not just tickers, but entries, mandatory exits, and clear risk-weighted profit targets. And the report also lists a few additional names to watch that support these themes.
Right, things like Grow Generation, GRWG, which is related to the cannabis trade.
And defensive names like Procter & Gamble and McDonald's and another industrial play in Caterpillar. It all solidifies that recommended bias towards safety, value, and momentum-confirmed oversold sectors.
Okay, so we have these high probability setups. But the KING-KAMBUF report is also deeply cautious about the macro environment. Let's talk about Section 6. Critical risks and the weekly outlook.
This is so important. Discipline means knowing when a macro storm can completely invalidate even the most perfect micro setup. And there are some big risks on the radar.
The primary structural risk is valuation, right?
Without a doubt. Valuation compression. The S&P 500's PE ratio is sitting at 27.88.
Which is high historically.
Very high. The long-term average is closer to 15, so you're paying almost double the historical average for $1 of earnings right now.
And the cyclically adjusted number, the Shiller TPP, is even more extreme.
It's even more worrying. The Shiller KPE is at 39.42. A number near 40 has only been seen at the absolute peak of the dot-com bubble.
So what does that mean in practical terms?
It means the market has no room for error. When valuations are this stretched, any disappointment in earnings or economic data gets amplified massively.
Which ties directly into the second risk, the AI bubble concerns.
Exactly. Oracle's guidance already showed us how sensitive these stocks are to bad news. And the report highlights that even though the indices are near their highs, the market's internal health, or breadth, is weakening.
The advance-decline ratio is deteriorating.
Right, which means fewer and fewer stocks are actually participating in the rally. The gains are reliant on just that handful of mega-cap names. That's the definition of a fragile market.
Okay, so we have a fragile market with sky-high valuations. What events in the week ahead could trigger a problem?
The weekly event calendar is critical here. On the earnings front, all eyes are on Broadcom AVGO, which reports on Tuesday, December 16th.
This is a huge test for the semiconductor space after Oracle's report.
The first major test. If Broadcom misses or issues weak guidance, that tech pullback we saw on Friday could cascade into something much more severe very quickly.
We also have major economic data later in the week.
Yes, on Thursday, December 18th, we get retail sales and the producer price index. The guide strongly advises caution around these releases. Don't initiate new large positions in the 30 minutes before they come out. They have the potential to completely change the narrative.
So given this tension, high conviction trade setups on one side and elevated macro risk on the other, what is the final recommended portfolio bias from the report?
The strategy is unequivocally selective strength with rigorous risk management.
Break that down.
It means you maintain your core holdings in strong sectors like financials. You execute those 5 tactical T-KIF trades, but you do it with strict adherence to the 2% rule and hard stops. And critically, you maintain a significant cash position.
The report recommends 15 to 20% cash. Why is that so important right now?
That cash is your insurance policy against that VIX complacency. It's your opportunity fund.
To buy the dip if there is one.
Precisely. If volatility does strike, and it often does when everyone least expects it, having that 15–20% cash allows you to be aggressive when others are fearful. You can pick up these great setups at even better prices.
Okay, let's wrap this all up. To synthesize everything we've extracted from the KING-KAMBUF Market Digest, the market environment as of December 12th is defined by this core conflict. You have a resilient Dow and financial sector fighting against sharp, concentrated selling in tech and AI.
And it's all happening under this strange, quiet backdrop of extreme low volatility with the VIX near 14.85, signaling a dangerous level of complacency.
So the key takeaway for you, the listener, is that this report gives you a detailed roadmap to navigate that tension. But the success isn't in the stock picks themselves.
No, the success is found entirely in the strict adherence to the T-KIF Plus discipline, the mathematical 2% rule, the non-negotiable hard stops, and that systematic scale-out strategy. That discipline is the only antidote to a structurally fragile market.
Follow the plan, manage the risk first, and the profits will take care of themselves.
That's the entire game. And if we connect this to the bigger picture, given that the S&P 500's Shiller-Kate is near 40 and the VIX is signaling that nobody is worried, the market is positioned as if risk is low. So this raises a final, important question for you, the learner, to think about this week.
What's that?
If everyone believes the risk is low, where is the highest hidden risk actually concentrated? And how much cash should you be holding to capitalize on the inevitable high probability surprise that results from all that complacency?
Perfect thought to end on. Go back, review those T-KIF rules, set your stops before you enter any trade, and we'll catch you next time here on The Deep Dive.